December 2nd, 2001. One of America's largest companies officially declared bankruptcy. Almost overnight, more than 20,000 employees lost their jobs. Billions of dollars in retirement savings disappeared. Investors were left with worthless stock. The company once praised as the future of American business had become little more than an empty shell. But Enron didn't collapse because of bad luck. It didn't fail because energy prices changed. And it certainly wasn't a victim of the economy. It collapsed because, for years, its executives had built an empire on lies. Hidden debt, fake profits, manipulated accounting, a financial illusion so convincing that even Wall Street believed it. By the time the truth finally surfaced, the damage had already been done. This is the story of how Enron became the biggest corporate fraud of its generation. In the 1990s, Enron wasn't just another energy company. It was considered the future. Originally created from the merger of two natural gas businesses, Enron quickly transformed itself into something much bigger. Its executives claimed they weren't selling gas anymore. They were reinventing energy itself. The company began trading electricity, natural gas, broadband, weather contracts, even ideas. Wall Street loved the story. Analysts called Enron innovative. Fortune magazine named it America's most innovative company 6 years in a row. Its stock price exploded. Investors couldn't buy shares fast enough. Employees proudly invested their retirement savings into company stock. Everything pointed in one direction. Up, or at least, that's what everyone believed. The secret behind Enron wasn't brilliant innovation. It was accounting. Specifically, an accounting method known as mark-to-market. Normally, companies report profits after they actually earn them. Enron did something very different. The moment they signed a long-term contract, they estimated how much profit that contract might generate over the next 10 or 20 years. Then they recorded that estimated future profit immediately, even if the money had never been received. Imagine signing a 20-year contract worth $1 billion. Instead of waiting 20 years, you report the entire expected profit today. It looked incredible. Quarter after quarter, Wall Street saw explosive earnings. Investors saw unstoppable growth. But the numbers weren't based on reality. They were based on optimistic guesses. And those guesses became increasingly detached from the truth. Eventually, even fake profits weren't enough. Enron had another problem. Debt. Lots of it. The company had borrowed billions. If investors discovered the true level of debt, confidence would collapse. So executives came up with an extraordinary solution. Hide it. They created hundreds of special purpose entities, companies that existed almost entirely on paper. These entities borrowed money on Enron's behalf. The debt disappeared from Enron's balance sheet, at least on paper. To investors, Enron looked financially healthy. In reality, the debt was simply wearing a disguise. Every quarter, the illusion grew larger. Every quarter, the risk became greater. And almost nobody noticed. Inside Enron, some employees knew something was wrong. One of them was Vice President Sharon Watkins. After reviewing the company's accounting practices, she became deeply concerned. In August 2001, she sent a confidential memo to CEO Kenneth Lay. Her warning was direct. If the accounting practices became public, the company could collapse. Her fears proved correct. The problems weren't isolated. They were systemic. Years of manipulation had created a financial time bomb, and the countdown had already begun. By late 2001, analysts finally started asking difficult questions. Confidence disappeared. The stock price began falling. Banks demanded answers. Credit evaporated. Then the hidden debt became impossible to conceal. The carefully constructed illusion shattered. In less than a year, Enron's stock collapsed from more than $90 per share to less than $1. Employees lost retirement savings. Investors lost billions. One of America's largest corporations disappeared almost overnight. At the time, it was the largest corporate bankruptcy in U.S. history. The fallout extended far beyond Enron. CEO Jeffrey Skilling was convicted on multiple counts of fraud and conspiracy. Founder Kenneth Lay was also convicted, though he died before sentencing. Enron's accounting firm, Arthur Andersen, one of the big 5 accounting firms in the world, collapsed under the weight of the scandal. The case transformed corporate America. Congress passed the Sarbanes-Oxley Act. Financial reporting rules became significantly stricter. Companies were forced to become more transparent. The scandal changed Wall Street forever. Enron didn't fail because markets changed. It failed because perception became more valuable than reality. For years, executives convinced investors that success could simply be engineered through clever accounting. But numbers have a habit of revealing the truth. Sooner or later, reality always catches up. The Enron scandal became a warning to every company, every investor, and every regulator. No corporation is too respected a question. No balance sheet is above scrutiny. Because behind every financial empire, there is a story waiting to be uncovered. And every dollar leaves a trail until someone decides to follow the money.